Walmart's about to report earnings. Is it a good stock to buy now? Welcome to Global Value. Today, we're performing a fundamental analysis of Walmart using Warren Buffett's investing framework. We'll look at 6 key financial metrics before we figure out 3 different fair values to understand what Walmart is worth in today's stock market. Plus, I'll share 2 special bonuses that could be the deciding safety factors when adding Walmart stock to your portfolio. Right now, Walmart trades for $68.70 per share. In its last day of trading, it's up 1.1%. Since August of 2023, Walmart stock has climbed 28%. This is beating the market and the S&P 500, which is up 17% at the same time. In the last 5 years, Walmart has compounded at 12% annually, again beating the market. In the last decade, they're compounding at 10.5% annually, where they're neck and neck with the market. And when we go back before the global financial crisis, in the last 19 years, Walmart has compounded at 8% annually. Their stock has kept up with the S&P 500, but that's not all for shareholders. Right now, Walmart pays a 1.17% dividend yield, and they're a dividend king, growing these 51 years in a row. Today, Walmart trades $3 below its 52-week high, which is up $20 from their 52-week low. And how big is the company? As the world's largest in-store retailer, they have a $546 billion market cap. Getting started with our first metric, we want Walmart's average returns on capital to be greater than 14%. Think of returns on capital like your form when you're in the gym lifting weights. You want great form, just like a company wants great returns on its capital. Walmart has earned steady, stable, and increasing returns on capital over this time. They raised these from 13% at the beginning of 2020 to more than 16% in 2024. A normal business only earns 7% returns, and Walmart over this time averages 15%. That's slightly better than what we wanted, meaning it's a strong and stable check to start metric number 1. Now, what does Walmart really do? Walmart serves as the preeminent retailer in the United States, with its strategy predicated on superior operating efficiency and offering the lowest priced goods to consumers to drive robust store traffic and product turnover. Walmart augmented its low-price business strategy by offering a convenient one-stop shopping destination with the opening of its first supercenter back in 1988. Today, Walmart operates over 5,200 stores in the United States, including Sam's Club. It also operates 10,000 stores globally. Walmart generated over $440 billion in sales in the United States in fiscal 2024. Sam's Club contributed another $86 billion. Internationally, Walmart generated $115 billion in sales. The retailer serves around 240 million customers globally every week. Next, we want growth in their sales, earnings, and free cash flows to support their high returns on capital. Walmart has grown their sales by 25% from 2020 until today. The company's earnings have also grown by 27%, yet the company's free cash flows have only grown by 2%. So why do these lag? This has to do with the company more than doubling its capex over this time. They spent $20 billion in 2024, which is as much as they spent in 2020 and 2021 combined. Overall, their capex has increased since 2021, and it's something to watch out for, especially as you want them to continue getting good returns on their investments. Still though, all 3 of these are up, and it's another check on our second metric. Things are looking good for Walmart so far. Next, who owns Walmart? Today, Walmart stock is owned by 4 super investors, and this is led by the Bill and Melinda Gates Foundation, who has around 1% of their portfolio in the business. Before then, Warren Buffett was a major shareholder, buying the stock in the early 2000s and adding on more throughout the global financial crisis before he finally sold late in 2018. In our third metric, we want to view Walmart as an individual shareholder. This is why we're looking for earnings per share growth. Walmart's grown their EPS from $1.73 in 2020 to $1.91 to start 2024. In the last 12 months, this has grown even farther to $2.33. Walmart's grown their earnings per share, and it's another check on metric number 3. Metric 4 is similar but even more important. We want free cash flow per share growth. Walmart's cash flows are up just slightly over this time, but they're boosted along on a per share basis due to some buybacks. Walmart's repurchased 6% of their shares outstanding, which means their cash flows per share have grown even faster than this. It's another check, with 2024 cash flows per share coming in at $1.87. So far, Walmart is perfect. Now, why don't we look at the company's dividends? Right now, Walmart is a dividend king, growing their dividends 51 years in a row and paying a 1.17% dividend yield. The question to ask is Walmart's dividend safe, and can it keep growing in the future like it has in the past? This is why we want their dividends to be covered by their cash flows, and Walmart's done a great job of supporting these in these last 5 years. The company's grown their dividends by 1 penny a year over this time, and they're easily supported by their free cash flows. Today, they have a comfortable payout ratio of 35%, and they grew their dividend by 9% last year alone. Coupled with their slight share buybacks, Walmart currently pays a 1.5% shareholder yield, which is supported. It's another check here on their dividend bonus, and things are looking great for Walmart. This is classic slow, steady, and reliable growth. Next, let's look at Walmart's balance sheet. Warren Buffett wants companies that grow, earn high returns, and don't use a lot of debt. Walmart fits that description. The company's lowered their net debt from $63 billion in 2020 to $53 billion to start 2024. They've raised this since then, and today it sits at $57 billion. Thankfully, that's no concern for the $78.5 billion of free cash flow that they brought in over this time. Walmart comfortably supports their net debt position, and their long-term capital structure looks to be in great shape. It's another check here, and Walmart's still perfect. Do they have what it takes to be a perfect Select 6 stock? We'll find out right after we cover our key safety bonus. Warren Buffett's teacher and the father of value investing, Ben Graham, wanted a current ratio bigger than 1.5 times. This guideline is a key safety ratio when you're picking individual stocks. For Walmart, though, it's a little bit different. They've been below 1 times in all 5 of these years and way below that benchmark. So what gives? Walmart has different working capital requirements than most companies. As a large retailer, they have a ton of market power over their vendors. They make huge purchases at low costs and with very favorable terms from their suppliers. Because of this, Walmart doesn't need a ton of current assets compared to their current liabilities. While it's technically an X, we're not going to count this against Walmart, and it's something worth knowing as a shareholder. Now, what is the company worth? The big metric of them all, metric number 6, is also our first valuation. We want Walmart's average cash flows divided by their enterprise value to give us a yield greater than 5%. This would match the historical yield from the S&P 500 and be greater than the 10-year Treasury. Today, Walmart has a $610 billion enterprise value, which is what we get when we add their market cap and net debt together. It helps us look at Walmart more like a private company. In an average year over this time, Walmart brings in $15.7 billion of free cash flow. When we divide that by their enterprise value, it only gives us a 2.6% average yield. In their last 3 years, they have a 2.3% average yield, and in their last 12 months, they brought in $14.5 billion of free cash flow. That gives us a 2.4% current free cash flow yield. All 3 of these are coming in around half of the benchmark we were looking for, and they're below the 10-year Treasury mark. This means on metric number 6, it's an X for Walmart. However, don't just throw the business out. We still have 2 more valuations to look at before we reveal their fair value at the end of the video. Next, we want to give credit to Walmart for its growth. That's why we'll use a DCF model to grow their cash flows using historical assumptions. Keep in mind the company had been very predictable in their past, but that wasn't the case during the pandemic. Still, let's take their cash flows and assume that these grow at 5% for each of the next 10 years. Then in the following decade, we'll assume that their growth slows and these only grow at 4% annually. After that, we'll add in their tangible book value to estimate their net worth. If we want to see a market-beating 15% rate of return, which is the same return that Warren Buffett looks for from his investments, then based on these assumptions and their valuations, today a fair value only comes in around $22 per share. That's down significantly from their stock price. Much of this is because Walmart is a slow, steady, and reliable business that's currently trading for some high valuations. Today they trade for a PE of 29.5 times. This is above their median for the last decade and more than double their low of just 12 times earnings in the last 10 years. More crudely, they're trading at a decade high for their price-to-sales ratio. In its history, Walmart's one of the greatest performing stocks of all time. Since the turn of the 21st century, though, it's more or less kept pace with the market. These past multiples and slowing growth assumptions are why our third valuation only comes in at $56.5 per share. Still, Warren Buffett likes the numbers, but it's the qualities of a company that he cares about even more. Why don't we learn what these are for Walmart through a long and a short thesis? We'll start with a long thesis first. Number 1, margin pressure should abate as Walmart's recent investments in omni-channel fulfillment and its third-party marketplace continue to scale. Number 2, Walmart's vast grocery offering insulates the firm from digital competition, given the perishability and the difficulty with the grocery supply chain for merchandise. And number 3, Walmart's recent investments in supply chain automation should drive margin expansion. The firm may also reinvest the cost savings to hold down prices and drive foot traffic to its stores, a benefit relative to many smaller retailers. But things aren't all positives. Let's look at a short thesis as well. Number 1, Walmart's third-party marketplace and third-party fulfillment capacity pale relative to Amazon's scale. Amazon can underprice Walmart on commissions, listing fees, and fulfillment services related to its marketplace. Number 2, Sam's Club has woefully underperformed Costco in recent years. The brand doesn't provide a compelling value proposition that would allow Sam's Club to take more market share. And number 3, Walmart's sales mix of higher margin general merchandise categories stands to decline due to strong digital penetration. This could mean a long-term decline in margins. Now let's put everything together for Walmart. In our fundamental review, we learned the company goes 5 for 6 on the Select 6 analysis. Walmart earns stable and high returns in the mid-teens. They've grown slightly but increased their capex in the last 5 years. They've also bought back shares, and they continue to pay a steady and reliable dividend as a 51-year dividend king. On top of this, Walmart uses a modest amount of debt in their business, and they do generate a consistent amount of cash flows in most of these years. Future returns may be lower for the stock. Remember, this isn't financial advice. Still, though, the company is being highly valued, increasing by 28% in the last year alone. Relative to its cash flows, valuations look like they may be stretched for Walmart. Still, based on the numbers and their qualities, today it looks like a fair value for Walmart comes in at $43.50 per share. That's down from their stock price and their 52-week low. Walmart looks overvalued. To find stocks that are undervalued, sign up for our investing tools, make requests, and get exclusive bonus coverage of 110 stocks and counting.